You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com and co-hosts, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
All right, everybody, welcome back to the Option Block, everyone's favorite bi-weekly source for all things options related. I apologize for a little bit of construction background ambiance there, but they're doing some work here next door in the building, and it is bleeding through our studio walls, no matter how well shielded and thick they may be. At the end of the day, a hammer, or indeed a jackhammer, cannot be stopped, but the show cannot be stopped either. Don't you worry, listeners. We are, of course, bringing you your favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of analysis, a little bit of education, throw on some unusual activity, and a sprinkling on top of some of your questions, and you have the heady brew that is the Option Block. My name is indeed Mark Longo from the aforementioned OptionsInsider.com, as well as, of course, from the old Options Insider Radio Network, and there are no shortage of places for you guys to find all of the great Options Insider goodness that we have for you. Of course, the mothership, the flagship, theoptionsinsider.com. Pretty much everything is available there. All the content, educational, analytical, unusual activity, a lot more than we have time to get to on this program. So if you like the Odd Block, we certainly have some of that in store for you there. There they are, hammering again, listeners. And, of course, we also have the whole Insider Radio Network. Click on the Radio Network tab, and you're off to the races there. And, of course, breaking news in the options market, all that fun stuff. And if that's too much work, iTunes, TuneIn, Stitcher, pretty much wherever you find your favorite podcast, we're there. And if that's too much work, grab our mobile app, iOS, Google Play, and the Amazon App Store. No shortage of ways for you guys to get a hold of us here and listen to the program, listen to the content, and hopefully enjoy it. And when you're done, or while you're doing it, shoot us your questions, your comments. We love to hear from you guys. Unless you're the construction crew next door, then we don't want to hear from you. But, of course, I'm also joined on today's all-star panel here. A very hot and heavy day in the market from an earnings perspective. For a truncated panel day, I am joined by the Greasy Meatball himself, Mr. Mark Sebastian. Mr. Greasy Meatball, welcome back to the program. It's not you knocking down my walls over here, is it?
No, that's not. If it was me, I would have been through it. You know, I'm like the Juggernaut. You know, I just crack through walls.
Yes, when I look at you, I immediately think towering, unstoppable behemoth. That is just the
as do most people.
Immediate thing that leaps to mind.
Or they think of the guy from Rudy.
Yes, that's true.
5 foot nothing, 100 and nothing, which is more me.
At least you know where you stand, which is always a good thing in life. Uncle Mike Tusaw, unfortunately, could not be standing with us. He is still on assignment out there in St. Charles, wrapping up some odds and ends from the big Tusaw family move this week. So he'll be back next week with a lot to chat about. Unfortunately, we couldn't have him on this week because, of course, it's a big week for him. At least it used to be Apple earnings. But still, we'll get into all that fun stuff in the trading block. So without further ado, let's dive right into it.
It's time to break down the latest topics, trades, and trends in the world of options.
All right,
it's time for
to the Trading Block. This is indeed the portion of the program where we break down what's moving, what's shaking, what's lighting up the old market today, and a bit of a down day on the old street today. Most of the major indices closing substantially lower. S&P in the middle of the pack there, down a little bit over half a percentage point today, or about a little over 13 handles, closed right around the 2100 level. The Dow leading the charge to the downside, down about 3/4 of a percentage point or so, and the Nasdaq 100 actually only down a little less than half a percentage point. That's a little bit better than it was. Nasdaq was leading the charge there for a while. Of course, Nasdaq getting a lot of downward pressure on it of late as a result of, shall we say, less than spectacular earnings for a lot of the big technology names out there. For those of you playing the home game, by the way, we are recording this on Thursday, July 23rd, for all of you out there, so you know exactly where we are in the discussion. And Mark, let's get right into it. We'll dive into some of the earlier names in a second, but first, give me your take on kind of what caught your eye in today's activity.
I mean, it was just one of those weird days. With the way earnings have been going this cycle, it's kind of turned into something where, we have, Apple that's a huge portion of the Nasdaq, or IBM that's a big portion of the Dow, actually Apple, big portion of the Dow, and they're really able to pull kind of all the markets down with them. So, we've had a couple of earnings season is going okay, I understand, but some of the real big mega cap names have come up relatively short. Today Minnesota Mining and Manufacturing missed it. Yesterday Apple and IBM and Microsoft. So we've been seeing a lot of these mega cap companies short, even as, on the whole, most of the other companies have done okay.
Yeah, it's true. There's kind of a few firms out there kind of taking up the lion's share of the mind share out there. Of course, Apple being amongst them, as it is wont to do on pretty much any given trading day. But you're right. On the kind of an aggregate basis, a lot of the smaller names doing all right, but the headline-making names, those, of course, leaning to the downside. We'll start, of course, with the aforementioned fruit company. They did take a decent shellacking, shall we say, coming out of their earnings earlier this week. They closed right around 131. That straddle at the time went out a little over $6, so it was a little bit south of 5%. They were pricing in from a movement expectation there. We saw it get down on the open to about 122, a little bit south of that briefly, and it rallied up since then. So it was a nearly 9-handle swing at one point. So all the premium sellers out there had to sit on their hands for a little bit before it got a little bit better for them from that perspective. Of course, net fall about 4.2% after, of course, iPhone sales and revenue missing estimates, an unusual thing for Apple to do. That's kind of the downside of being a market darling, a zealot darling, is that when you don't blow the doors off every time, they tend to lean on you a little bit. One of the missing components here was the watch. They didn't pull that out separately. A lot of people were looking for that. When they don't pull it out separately, it kind of makes you think maybe it underperformed. I think if you do some voodoo with the numbers, you can kind of guesstimate that it worked out to, I think, around 980 million or so for the watch. I believe that was a number. But that's kind of a guesstimate from pulling out some of the hardware numbers compared to last quarter. So overall, we still don't really know how the watch is really, if it's really moving the needle or not. Although, given the numbers and everything else we're seeing, seems like the answer is a resounding no. Any of you folks out there in the pit chat, Mark, lighting it up with Apple, doing a lot of Apple trading these days, and what was your take on the movement we're seeing post-earnings out there?
Yeah, that Apple story was kind of silly. They tried to pass off, the Apple Watch, it's outsold the iPhone and the iPad when they launched. And it's just
that's kind of a meaningless number.
That's terrible. I mean, yeah, well, when they launched the iPhone, the 86 million iPhone users didn't exist, and iPad was basically creating a whole new product. The watch is just a flop. And, we were kind of talking about this with a few other traders, and I talked to a guy that actually is involved with one of the gaming companies that deals with Apple, and he was basically telling me that everybody at Apple is running around because the watch is doing so poorly. And I think their big issue is that, there's no cachet, there's no cool. I mean, for $10,000, people will buy a Rolex, some sort of antique Rolex, or they'll go out and get a Breitling or an Omega, or if they want to spend $1,000 or $1,500, maybe they'll get a Movado or something like that. They're not going to buy like a little electronic doohickey. So their sales on that watch, not good. The way I kind of ended up playing it was kind of bearish into the earnings. Worked out beautiful. Traded basically, it opened on my short strike of the fly that I set up. And then
Nice when that happens, isn't it?
It is nice when that happens. And then coming out of it, I actually flipped to long because one thing we know is that Apple does produce a lot of cash, and it produces a lot of fanboys that will buy every dip. And so coming out of it, we at Option Pit have kind of set up a little bit of a bullish play, targeting it to move back toward that 130 level, which, I think will happen between now and August expiration.
Yeah, it's hovering today right around 125, so it has gained back some of those earlier sales. It seems to have kind of settled in around this 125 level. We'll see if it holds it, but for now, at least, seems to be holding it. It is a nice feeling when you open up on your short strike. You got that kind of that Hannibal of the A-team feeling. I love it when a plan comes together. Whenever you see it come out, because it happens so rarely. So when it does, you have to kind of just celebrate and enjoy. But you're right, the Apple Watch thing. Not to make it too much of an Apple show, but it is even more of a misleading indicator than you think when you compare it to iPads and others, because those are only available domestically, and the watch is available pretty much everywhere, including China, and yet they're still comparing it to early iPhone and iPad numbers. So it's a very, very misleading number because they have a much larger potential market to sell this thing to, and at least so far, not exactly seems to be resonating. And you're right about the high. I never understood the high end of trying to sell one of these things for $10,000, because at least one of those $10,000 Omegas or Rolexes or whatever, they're going to last you for a couple of decades, probably at the very least. It's just a mechanical thing that's going to keep on going. It never really becomes obsolete. At the end of the day, and if you cover an Apple Watch in gold and silver and jewels, it's still in guts is a thing that's going to be obsolete in a couple of years at most. So I can't imagine anyone plunking that down to pretend this thing doesn't have built-in obsolescence. It's got a battery, for God's sakes, it's going to run out in a couple of years. You can't replace that, not user replaceable. So there's a lot of built-in obsolescence, as there is to all Apple products, and that kind of makes it, on the other hand, hard to sell this kind of and position it as this kind of long-term, exotic, expensive, almost durable good, like they're trying to place it as right now. This thing is going to last you a decade or more, and that certainly is not the case. Speaking of other big tech names that have disappointed before we get to the names coming out today, Softy, the old other one, kind of making some headlines this past week as well, posting their largest ever quarterly loss. They closed right around 47 and a quarter or so going into their earnings. That Straddle priced a little bit shy at 250, right around 240 or so, which worked out to about 5% or so. They opened up down about $2, so they, at least as opposed to some of the other names, are not blowing through what the market was expecting, but still not good news. Another one that's kind of had some issues. We've talked about Microsoft of late in the last few quarters, and the better part of the last year, kind of becoming rehabilitated as an options relevant name. For the better part of the last decade before that, it was really kind of a lost name. It was a decent premium, right, going into earnings because it was reliable, would never do anything. So you weren't getting a lot for it, but you were getting something, and it was pretty reliable. So some people would lean on it for that reason. But other than that, it never really did much of anything. And over the past year or so, that narrative has changed. The underlying is kind of moving a little bit, some change of leadership over there, a little bit of vol back in that name. And of course, now had the largest ever quarterly net loss back in January. So it's been a rough couple of quarters for them. The Nokia thing not exactly working out well for them. Mark, I don't think I've talked with you that much about Microsoft. Seems to be more of an Andrew favorite. Do you vacillate around in Microsoft at all these days? Do you watch it at all?
It's an interesting one to watch. I mean, it's the third biggest company in the world, so ignore it at your peril. And this Windows 10 and some of the things they're doing on the mobile side, I think are really interesting. There is 8 was just a kind of a flop, but the new Windows 10, they're the way they're pitching it, this kind of like the what was the one that was terrible? It was Vista.
Vista,
and then they fixed it.
Windows
with 7,
8 was no home run either, but Vista is the one everyone remembers.
Yeah, Vista everybody hates, but then they came out with 7, and everyone thought it was like the best thing since sliced bread. So, and the fact that they're upgrading everybody for free, it's going to keep people in their ecosystem. And I think they're doing some good things. Nokia, an absolute mess. They've never been really in the business of device making, aside from the Surface, which is doing, moderately well, but, and the PlayStation, which is, they're going to a dying business long term. But
Xbox, but close enough. Yeah, PlayStation, Xbox. Half a dozen, one six the other.
Not PlayStation, Xbox. Well, they're both long-term dying businesses. So, and one of the things is, you look at these one-trick ponies, and this is why Apple. People always say, why does Apple trade at such a discount? Well, Apple trades at such a discount because people saw what happened to Sony, and what's kind of happened to Samsung. Remember when every Sony was super cachet? You wanted a Sony.
Sony was the Apple of the 80s. They had all the premium. Yeah,
they did. And then look what happened. Do you own anything made by Sony anymore?
Except for the aforementioned PlayStation, I can't think of anything. Maybe a Blu-ray player somewhere.
Yeah, I mean, I might my DVD's Panasonic. Yeah, I got nothing. And so, that is what people worry about with Apple. And this watch and Apple TV have both kind of flopped. The iPad has stopped growing. The iPod has been completely destroyed by the iPhone. So, if somebody comes out with something cooler than an iPhone, Apple's got problems. So, now they've, when I look at Microsoft, what happened, Microsoft is kind of recovering from kind of being the Apple of the 90s when it came to operating systems and things like that. So, and they're finally kind of pulling their stuff together. They're also recovering from decades of Steve Ballmer, but that is its own story. So, that's kind of my take on Softy. I would be surprised if it doesn't make a quick recovery just like Apple.
Yeah, they're kind of a weird one. You're right. They have this legacy business that just prints money hand over fist, but it is indeed contracting at some point in the near future. Desktop operating systems probably won't be the cash cow they are today. So they're having this transition acquisition mode. They bought Skype for the second or third time after it was dealed, after it was flipped by other people. They have, of course, the Nokia deal. They're trying. The Surface is interesting. Actually, probably doing a lot better than people expected it for kind of an also-ran iPad. It's kind of become a new thing, kind of a tablet laptop hybrid thing, which people actually seem to like who have them. I don't have one. Nokia phones are nice. They just never really were for sale much in the U.S., and they have their own issues. But they are trying interesting things. So we'll keep an eye on them as we move on into some more current events, things that are breaking today. Today is, of course, Thursday, July 23rd, one of the most active earnings days on the calendar. Some big names coming out today, including we're talking tech. So let's dive right into Amazon. They closed today right around, about 482 or so. That straddle going out about 45.5 or so. So a little bit south of 10% there on that straddle, about 9.5% or so what they're pricing in. Looks like the number is out, and it seems like the street liking what they're seeing out here, because that's the price. They priced in about a 45 handle move, looking at about a 71 handle move so far in the after hours, up nearly 15%, hovering right a little bit north of 550 right now in the after hours. So perhaps another potential Google move type on our hands here, of just not just blowing through the straddle, but continuing to blow through to the upside. Saw a very aggressive day overall from a volume perspective, about 70,000 contracts. ADV doing over 200,000 today, nearly 210,000. So nearly 3x that today, and a lot of it on the call side, about 1 in the 6.6 calls over put. So perhaps a lot of those people taking the Sebastian directional approach here to the upside, and perhaps paying off. There's liquidity on every strike. I'm looking at the weeklies. There was about nearly 3,000 of the July weekly. So they expire pretty much at this point. They are dailies. They expire tomorrow. Nearly 3,000 of those went up today, which seemed like madness, and now are close to being in the money. So let's see. They went out at $127 for the 560 call weekly going out tomorrow. Amazing, and they might actually have a chance of paying off. So all sorts of madness afoot. Oh wow, there's a 1,300 lot of the weekly 570 calls went up today as well. I don't see. Maybe there's a spread leg. Hopefully there's a spread leg on that. Hopefully that's a 5 double 570 vertical. But yeah, some interesting paper out here to say the least. I'm not sure if those 570s have a chance, but the 560s seem to have a decent probability here of working out. Mr. Sebastian, what was the take today in the pitch chat? Anybody really lighting it up out here in Amazon? Hopefully none of those weekly 570 calls were in your pitch chat.
Well, that was all me, all 1,300.
That screams Sebastian.
Yeah, Andrew and I were talking. We looked at that Straddle, and both said, that seems too cheap. After we saw what happened with Google, and Mark, what we're starting to see is really a theme to technology. We're seeing the kind of content providers, the content delivery providers do really well, right? Google did awesome. Netflix, awesome. Amazon with their Prime Day did awesome. And so you look at who failed, and it was kind of the hardware people that are having problems. So your IBMs, your Apples, your Microsoft. So this earnings season, we're seeing the social and the content delivery and the kind of service do really well, while the device makers kind of have issues. So, that bodes potentially very well for a name like a Facebook, maybe even a Twitter or a LinkedIn. So it's a really interesting development that we're seeing kind of across all of the earnings.
Yeah, it seems like Google and kind of Netflix set the pace for it, particularly on the tech side. People are starting to widen out a little bit on the earnings and the vol and the straddles, and yet still perhaps underpriced or clearly underpricing in Amazon for if this move persists here in the after hours. I was just digging in while we were talking. It looks like a 400 and change of the July weekly. So daily at this point, 595 calls went up. They were on a spread, so I'm going to hope that is some sort of vertical, and this is the short leg. They went up mid-market, so it's hard to tell if they were at first blush what exactly they were up to here. I'm going to give them benefit of the doubt that was some crazy other leg of the vertical. They got them off, but they were selling for about 40 odd cents. So that shows you how much upside call love there was out there in Amazon today, because someone was buying those for 41 cents on the other side of that, listener. So perhaps some of these names we are getting back to the old Apple days of any call, any time. And for you guys out there who hopefully have more level-headed, that gives a lot more fun vertical opportunities. Perhaps our friend here taking advantage of just that. Interesting timing, really quickly, before we get into the odd block. Interesting timing for Amazon, too, to be having this aggressive rally. Just yesterday, the day before, they launched that big quote-unquote new competitor to Amazon, which is, I believe it's called Jet. And it's built by a guy who used to run diapers.com. He has some experience battling back and forth with Amazon, ended up getting acquired by Amazon, worked for them for 3 years with the non-compete, so he saw the inner workings and now has launched this new service directly, essentially to compete with them. It's kind of interesting that they have this extreme explosion to the upside a day or two after that service comes out. We'll see how that one plays out. And I know they've raised, I think, substantial, a couple $100 million in capital for essentially what amounts to a shopping aggregator. So they have some money to play with. We'll see how that works out. Either way, though, it seems to be working out for Amazon right now. Just rally ho mode, still 555 or so, 556 here in the after hours. We'll keep an eye on that. We got Starbucks as well and Chipotle to talk about, but we're going to keep on rolling right now into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, welcome to the Odd Block. This is indeed the portion of the program we break down what's lighting up the old tape from an odd options perspective, some of the weirder paper we're seeing going up out there. Going to kick things off in the petroleum realm. In particular, a name we haven't talked about in a while. This is Chevron Corporation, ticker symbol CVX, closing today just a tick under $93 or so, off about 60 cents today. So underlying movement wasn't what caught our eye so much, but there was some paper out there. This name does about 34 or so thousand contracts a day, doing nearly 55,000 today, about 1.6 to 1 calls over puts, and that'll show you where the interest was. And what caught our eye actually was a little bit longer term paper, not so much the 1 day kind we saw going up in Amazon, but a little bit farther out. In particular, the DEES expiration caught our eye. A little bit of a tight call spread out here. The DEES par 105 call spread going up, when we profiled it initially, about 9,500 times. Paper selling for 65 cents, went up in 2 blocks on the old Philly, where a lot of these types of trades seem to go up over there. They're a little bit more, it's like piled in another 500 or so towards the end of the day. So total of a little bit over 10,000 on this name on both strikes. Only 6,200 and about 5,000 open, respectively, on the 100 and 105 strikes. So clearly, this is opening paper. And it looks like it appears to be, we didn't see any stock going up with this. It looks like it is what it appears to be on the surface, which is someone coming in for a little bit of quick yield, perhaps, if they're an underlying holder looking to do a protected right over here, just in case Chevron does decide to explode to the north before the end of the year, doing it in a risk-mitigated fashion, and deciding they want to take home a nice 65 cents or so for their trouble. Mark, we've seen a lot of people going, farther afield for different yield type plays. That is indeed what this one is. We don't see a lot of them doing it in this protected type fashion. So that in and of itself is also interesting, let alone perhaps the strike selection and the size going up here in Chevron. All of those kind of worthy of note.
Yeah, there's a couple of things interesting. Chevron closed at a 4-year low today. So it's really down south. ExxonMobil at a 3-year low. So things are the diversified oil not doing so hot right now. One of the things that's kind of interesting, if this is a kind of a call overwriter, this is kind of like one of the nice things about overwriting via a call spread instead of just calls is, maybe this guy has a price point that's somewhere around $100 and he's willing to accept the premium. But then if the underlying kind of takes off, he's able to get his stock back above 105. So that could be kind of the setup that was put together here. Could be just a call spread seller, just somebody, trying to make a bunch of money in Chevron. Who knows? But, I was looking at calls. Both of these companies report later next week. I can buy the earnings call in Chevron for right around 1.1% of, an at the money. So right around 1.1% of the underlying cost. Why in the world would anyone own that stock into earnings when I can get calls ahead of earnings for a 1% premium?
That is surprising because it is getting into that window where you expect to see that starting to inflate. You're getting close to the day. What we're looking at here, the end of July, I think they're expected. 31st.
Yes.
So yeah, we're getting close to that. So they should be starting to be in that, to use your partner's favorite phrase, the juice for free phrase, getting into that. So yeah, that is a bit of a discount. And looking at a chart here, you're right. It has been kind of rough times for Chevron of late. Of course, these strike choices are fairly aggressive. I mean, it was at 100 not that long ago, just in mid-June, actually. So about a month ago, it broke through 100 to the south. And, of course, back in the go-go oil days of not that long ago, it was trading well north of 100 and got up even into the 130 range or so back about a year ago, back in July of last year. So there is potential for it to blow through those strikes. Perhaps yet another reason why he decided to go perhaps the saner route and add that upside leg, just in case the worst comes to pass. He can sleep at night with his call right, and if it doesn't, he gets the 65 cents. So he's not too upset, I don't think, either way. Interesting stuff, worthy of merit in and of itself. We don't see that many protected call rights out here anymore. Usually, people are so yield conscious in this environment. They're looking so far afield and jumping through so many hoops in terms of strikes and everything else to get any percentage point they can. They're afraid to give up any of it. So to have someone do any of that is almost worthy of note in and of itself. As we move on into our next name, this is a newcomer to the odd block. This is one of those funky ETF, in particular the Direxion Daily Financial Bear 3X shares. So if you like your inverse ratio type ETFs, we got you covered here. Ticker symbol FAZ, F-A-Z. Closing today, $10.38, up about a quarter or about 2.5% or so. This is the name that does about 5,200 contracts a day, doing nearly 8,000 today. So interesting stuff just from an overall volume perspective. And what caught our eye out here today in particular was some size paper fairly close to home. This is kind of reminiscent of what we were just talking about in Amazon, people slinging a lot of money on options that are going away tomorrow. Our friend here following suit. In particular, it was the July 24 weekly 10 halves. So particularly they're expiring obviously tomorrow, the 24th. The 10 half strike, paying a whopping 2 cents for these bad boys, about 6,000 times. Went up in one block on bats on a big sweep. It was looking all right. They're actually a nickel. They're actually 4-cent bid right now. So this trade so far, at least, he has doubled his money. He looks like a genius. 2,600 open on this strike. So if he is closing, he decided to go the other way with it. He pulled a Sebastian. He closed his short and went long. Either way, interesting stuff from a size perspective and just from a time frame. This is someone looking to hit a home run sometime in the next 24 hours. So by the time you listen to this show tomorrow, listeners, you'll know if our friend here on the weekly July 10 halves daily at this point is looking pretty good. Again, he went out $10.38. Let's see if intraday, if he ever flirted with that. Highest he got intraday was $10.46. So he was flirting ever so close to that level, but at the end of the day, it didn't make it. They traded 7 cents at one point today, so perhaps our friend picks some up in the morning and then dumps some out in the afternoon. Maybe, what do you think, Mark? Do you think our friend was that savvy, made a quick nickel? You think that's him?
I mean, who knows? One of the things with these triple ETFs is if we get like one more day of kind of ugliness tomorrow, this guy can make a lot of money really fast. He might have been setting up some sort of short-term hedge, doesn't like what he sees for the next day or two. Really, who knows? But and hopefully he did take that awesome nickel and pocket that.
I take that back. He was not awesome. He did the opposite. He bought more. He bought him up 4 or 5 cents, 6 cents, and he bought more at 7 cents. Or someone did. Someone followed up him. So someone loved these all the way up to 7 cents, about 100 or so traded there. Perhaps I gave him a little bit too much credit. 7 cents, that's a fairly aggressive level, shall we say. We'll pay attention to these ones, listeners, tomorrow. We'll see if our friend, if he breaks that $10.57 magic level tomorrow. Well, maybe the bulk of them went up for 2 cents, so he needs it really to be 10.52 or so, and then he'll be happy. The rest is kind of just the gravy at this point. But still, this is someone who needed to get some size exposure on this funky bear. You don't see too many of these size ones going up on the inverse anymore since they clamped down on the margin restrictions. For a while there was Wild West, almost literally, when it came to options on the inverse and type, ratio levered ETFs, and they have since clamped down on that. So not as cheap as it once was to sling some options. Still, 2 cents here is just 2 cents. So our friend here deciding to roll the dice, and at least so far, he's been right. If he can get out of if that 4 cent bid is still there tomorrow, I doubt it will be. But if a 4 cent bid is still there tomorrow, he might look like a genius. Otherwise, not so much. As we move on into our final name here, this is another newcomer to the odd block. So we got pretty much a trio. Well, Chevron's been on before, but it's been a while. And then the other two are newcomers. This is Patterson-UTI Energy, Inc. I know one of my favorites. Also got earnings today before the open. Ticker symbol PTEN, PTEN, closing today $17.13, up about nearly half a buck, or about 2.5%. This is a name that does nearly 2,000 contracts a day, lighting it up to the tune of nearly 18,000 today. And what caught our eye, a bunch actually looks like a little bit of a funky risk reversal / combo, whatever you want to call it. Out here a little bit farther out, not one day this time, but actually into 2016, in particular into the Feb 2016 chain, and doing it for some size. We first started profiling this morning when a 2,000 lot went up. The Feb 20 calls, paper buy-in, selling the Feb 14 puts, doing it for a nickel debit, so he paid a nickel to do the whole thing. So the call bid up over the puts in that scenario. As the day went on, he did it another 6,000 times to the tune of 8,000 contracts and change on each strike. The latter kind probably going up for somewhere around a nickel debit or so, in that range too. Size open interest on this one. This one is 10,000 each on the Feb 20s and on the Feb 14 puts. So here we are right in the middle of that range, and our friend deciding perhaps discretion, the better part of valor, as it looks like this is probably a close here on this risk reversal. Mr. Sebastian, take us home on our friend deciding no mas here on the PTEN risk reversal.
Yeah, I mean, apparently that's what he's doing. He's unwinding a risk reversal, probably thinks his downside risk isn't there anymore and that the stock has potential to really move between now and expiration. That's the reason why you shut one of these things down early. Paying to get out, I'd be interested to see whether he paid to get in or whether he was able to do that for some sort of credit getting in. But certainly an interesting one. Anytime you have to pay for a risk reversal that's relatively even spaced, that is usually not positive for the stock, but who knows? Maybe the guy really thinks the thing's going up. Maybe he thought he was investing in a urinary tract infection company.
Yes, I know.
And then when he
what
realized
caught
it was
your eye
oil,
about this
he
one.
said,
How did I know you would go there with this one? It's almost too obvious. But you're right. That's what caught my eye initially. Is you don't see a lot of these risk reversals going up for debits. So that's kind of interesting in and of itself. And so when you see that, you're right. Something is perhaps funky out there in that name, as usually the premium is going to be on the put side. Of course, you can structure those a little bit differently with the strikes, and he clearly did here. Either way, interesting stuff. Looking at a chart here, this name has kind of been vacillating between the mid-16 range up to about the 18, 19 or so range for the better part of the last month or so, and earnings had a bit of a range again today, got as high as about 1830 or so, and then kind of dropping back off again today. So if he started putting these on early, which he did, I could see why, those calls having still a little bit of a premium there because the underlying was in rally ho mode. People perhaps a bit nervous as to what exactly was afoot out there in that name. By the end of the day, you probably could have got better prices. Of course, again, hindsight, always 20/20 on these types of names post-earnings. Once things settle out, that's when the vol goes away and that balloon just pops amazingly. So interesting stuff out here in P10. I really want to keep an eye on our friend out here in Faz because he is just he is rolling those dice. So we'll see if his turn at the craps table is going to work out for him. As because it is Thursday, it's time for you guys to join us now. So let's keep on rolling right on into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, welcome to the Mail Block. This is indeed the portion of the show where you guys get to chime in with your questions, your comments, just to spread your options joy and indeed your option block love. No shortage of ways for you guys to do just that. Hit us up on the website. A lot of you guys like to use the contact form. You can easily do that. Hit the contact us button there on the bottom and it'll open up and you're off to the races. Of course, questions at theoptionsinsider.com. That also comes to us or via email, via Twitter, twitter.com/options, facebook.com/theoptionsinsider, and the few of you out there on Stock Twits who like to hit that up too. Stock Twits, we are just Options Insider, or grab it all via the mobile app. It's baked into the iOS version, not the Android version, unfortunately. Some bunch of questions here. Mark, I love when we get the Twitter questions because almost by the definition of that platform, it kind of people have to truncate these elaborate sometimes elaborate questions into 140 characters or less. And sometimes the crux of the question kind of gets lost in that. This is an example of that, I think. This comes from Sam A. He writes, hey, is it a good idea to sell credit spreads in leveraged ETFs to benefit from the contango? So there's a lot packed into this. I know this actually is funny because this hits a lot of your hot buttons. Of course, contango and ETFs, but very much I was thinking credit spreads because you argue that term does not exist. So yeah, kind of hard to really sink our teeth into this one because it kind of is. There's a lot. It doesn't really give us much specificity. It doesn't name the ETF. Doesn't name what kind of spread he wants to sell, what duration or strikes. So maybe we'll take it from a more 10,000 foot perspective. What do you have to say here for our friend Sam A? I think he's from Houston who wants to know if he should be blasting out credit spreads. And let's say the name we were just talking about. What was that funky leveraged ETFs? That was PTEN. Should he be selling it out there in good old? I'm not PTEN. I'm sorry. In our other good old inverse ETF 3X.
Yeah, that is not a. I understand why he's thinking that. I think there are smarter ways to play contango than via selling some sort of call spread or selling a put spread. There can be real action doing things like ratio, where you're kind of long one, short two, and kind of for your short strike. The key is, one needs to understand what the daily roll cost is, and that is how you build your strategy. And understand in a name like a triple FAS, a couple of bad days on yourself out. And so, I think there are better approaches than call spreads in those names. I don't know. What do you think, Mark?
That's not a bad response. But I think we talked about this actually not that long ago. It wasn't in the levered ETFs, although it still applies. When you and I were talking about some of the long-term puts in things like VXX and UVXY, which actually are some of the levered ones, and how the contango out there is kind of a no-brainer. You take some of those long-term, a year or two out, probably closer to the 2 year time frame, and you just set them and forget them in your IRA portfolio. And over time, that's going to be a pretty decent play, and you don't need to sometimes people overthink some of these things, and the performance isn't there. Obviously, he doesn't mention what ETFs. It could be index, it could be volatility, it could be crude, it could be any of the above. So those all have a little bit different contango structures, obviously, but I'm guessing he's probably fallen to some of the big products like the vol or maybe the index stuff. And certainly on the vol perspective, those long-term puts, it's kind of hard to beat that. If you want, you could finance that with some near-term trades, but those things tend to have the front end of the curve is that's where all the funkiness tends to happen. So maybe you don't want to get caught in that. Maybe you just put the long-term put on, and sometimes the Ronco trade is the right one to set in and forget it.
Yep, sometimes it is.
That man was an options genius. I don't know if you knew that.
Ron Popeil. I was on a plane with him one time. He's very tan.
Really? You met the man himself?
Well, no, I didn't meet him. I just saw him on the same plane as me, and he was tan.
Did he hand out chicken roasters to everyone around him in the seats?
You know what? No, but he did give everybody the pocket fisherman. It was really nice.
That would be the best plane ride ever if that was indeed the case. That would be awesome. Then the other guy, who was the guy who died, Billy Blanks or whatever, he gave out OxyClean, and everyone just had a good time.
Yep.
In terms of infomercials. All right.
Yep.
All right, let's move on to our next question here. This is, let me see here. We got a bunch of them here. Let me see. We got a few minutes. Let's go to, this is another common refrain. We've had different variations. It seems like this time of year, this earnings season, things starting rocking and rolling. And markets a little top heavy towards the north. People start writing in with this question en masse, so we might as well answer it now and get it out of the way again for the next quarter or so. This one comes from 999, the handle. I like that. He or she writes, "Hey, how do you spec on the market falling out of bed using options?" I wish I can kind of set my alarm clock by this mark, because this starts coming in right around this time. We see when the market sets up, getting a little frothy. We see earnings season now, certainly perhaps underwhelming to the downside, and so people starting looking at catastrophic, aka black swan, to use that horrible cliche type moves, and how do I spec with this? Using options. You and I have discussed this before. Some of the old way people expect us to come out kind of like the other question. People expect us to come out with all sorts of funky ratios and things like that to take advantage of these things. But sometimes, especially in that kind of environment where all hell is breaking loose and markets are super wide and getting anything off is really challenging. In those kind of environments, keeping it simple, stupid is a mantra that could probably serve you well. We don't talk about underlying that often, but in those types of scenarios, if you are indeed, this is that mythical scenario where you're certain that the market is falling out of bed for 100 handles or more in the S&P, something crazy. In that scenario, short future is going to work pretty well. That's straightforward and it works. Or if you go and SPY, short the ETF, whatever the case may be. But that's going to work fairly well, 1-to-1 with the market, ride it all the way down. That's a nice thing. The other side of that, if you can get them off, because they're hard, if you can get them, is of course that straight up protective put also works fairly well. If you can get them, again, that's a challenge, but this is, again, a mythical scenario, so we'll go with a mythical fill that you can just lift puts on whatever you want. But that said, if you can do it and the markets aren't atrocious, you get in before the move starts, perhaps you have some insider info, then, yeah, those both are simple and straightforward, and by gosh darn it, they work. Particularly as you break through your strike to the downside on that put, then guess what? It works kind of like a future, and you're loving it all the way down. So yeah, that works in those scenarios. Mark, do you take umbrage with that?
Yeah, I think this listener should listen to the Volatility Views podcast that we did last week with the Thompson boys. Their approach, I think, is the right approach, where the cost of hedging or speculating on some sort of big market crappage is just astronomical. We were, I've spent some time looking at this, and, you would have lost as much hedging with SPX options, on a kind of a 90-day roll as you would have actually lost in 2008. So I'm not a big proponent of, kind of straight up hedging, but I am a proponent of, waiting for the market to fall apart and then jumping on board. One of the things that we do know is that when the VIX crosses VXV, it'll give you a lot of false signals. But when that crosses, going short there has a positive expectancy since they began calculating VXV, which goes back to 2002. Now you've got 08 and 09 in there, and you've got 2011. But those are the type of events that this listener probably is worried about. And the best way to do it is, don't hedge when the S&P is 12. Hedge when, or S&P, the VIX is 12. Hedge when the VIX gets to 20, and there's actual real risk in the market. That is, market risk does not happen in a vacuum. All right, realized volatility leading into every major market crash had already picked up. Maybe 2011 or 2001 would be an exception, except for, as I recall, things were kind of ugly that summer already. So it's not like all is these things happen out of nowhere. There's almost always some sort of lead time. 1987, right? The S&P was down huge 2 days before the Black Monday. We've seen that over and over and over again. So that would be my thoughts to this listener.
Yeah, I forgot we did discuss this on a volatility terms anyway, but it's a similar conversation on last Vol Views episodes. Listeners, if you haven't checked that out, by all means, check that out because it's a similar conversation, just with more of a volatility bent. And you're right, Mark, that if you are doing this day in, day out speccing for that, that's expensive. It doesn't really work that well. I'm going with the mythical scenario our listener has created where you already know that this is perhaps already unfolding, in which case those are the scenarios where straightforward stuff, if you can get them off, they work fairly well. You don't need to, when it's falling out of bed, if you can get a put and get it at a good price and it's a reasonable strike, that's going to work. If you can sell a future, if there's a bid there to hit, it's going to work. You don't need to rack your brain. Usually there's not much time to rack your brain in those types of scenarios. So there we go. That's our market falling out of bed conversation for the quarter, hopefully. And now we still have some earnings cooking off, so maybe we'll just dive right on into an around the block, kind of with a bit of an update to it as well.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
Yeah, it is the heart of earnings season, listeners, and things are still lighting it up. Of course, Amazon, as we're talking, still rallying. So I kind of mocked that 570 strike earlier. Listeners saying I didn't think that was going to be coming into play. Well, as the show has progressed, that 570 strike has indeed come into play to the tune of trading right now 571.34 out there in the after hours. So breaking through that 571 handle, up nearly 89 handles at this point. So this is, if all things persist, this is a Google-esque blow through here for Amazon. Not quite as bad because Google had a similar movement, but I believe they priced it in about a $21 straddle. So at least it's only about a 2x blow through for Amazon versus about a 4x for Google. So percentage-wise, perhaps not as terrifying. Another name that was reporting today that we can get a chance to talk about earlier is, of course, good old S-Bucks. This is Starbucks making a lot of noise here today. His name closed today about 56.5, having done about 121,000 contracts. That's on an ADV of 24,000, so nearly 6x going up there today in good old S-Bucks. And this name, again, closing at 56.5, and so far at least compared to some of the other names out there, a much more tepid response. Rally, still a decent rallying in the after hours, nearly 3%, up about $1.63. Let's see where they went out here, where they were pricing here, if I can pull. Yeah, Straddle went out actually about 2.5 or so. So they're pricing in about a 4.5% move. They're getting about 3% as of now. We'll see if what happens as the after. It looks like they spiked up to maybe close to 4% earlier in the show here today. So we'll see if that persists. Still some interesting stuff. Mark, you never spent any time out in Starbucks on the Seaboat, did you?
You know what? I was more of a, no, I didn't really go to Starbucks that much. I figured, why pay $4 for a cup of coffee when I can go to Series and get one for 70 cents and they'll refill it over and over again, and I can talk to a Polish waitress.
Yes, that's true. I meant in the pit, but yeah, you can go to Starbucks at the coffee shop too. But yeah, I know you vacillated around a couple of different. I know Andrew pretty much traded.
That was not one I traded.
Every underlying. Yeah. It was out in the IBM pit. That's why I asked. That's why anyone touched it, because it was floating around there with the big name. Yeah, I dabbled in it a bit, but I didn't do too much in it. But good old S-Buck, still one that's fun to watch. We also have, of course, the name I frequently refer to as, shall we say, the Stealth Apple, of course, came out yesterday. Another one kind of lighting it up. They closed right around about 673 or so, and lighting it up to the tune of a little bit better the following day, opening it up about 20 odd handles or so to the north. And today, of course, trading about close to 50 handles higher, 725 today. So Chipotle, at least one of the few that's lighting it up to the upside outside of the tech realm, about a nearly 8% move, quarterly profit, beating estimates, and announcing a stock buyback that always helps the stock as well. So I guess tinfoil burritos are where the action is. You know, I've often joked about Chipotle on this show. Do you guys ever spend any time in it over there in Pit Chat Land, looking at the old Stealth Apple, or the former Stealth Apple?
That was a crazy earnings announcement yesterday. At one point, so it opens down 50 after earnings, and then makes a $50 reversal, and then another 50, moved $100 overnight. It was nasty. It was Netflix-esque in what it did to the traders that were in it. I mean, just nasty. Now, if you're long the straddle, you made a blasted killing, assuming you hedged both sides of it with stock. So, kind of a crazy one. I'll be honest.
Yeah, if you had some good gamma scalps working, you got a nice smile on your face. And if you're just a premium seller, you were perhaps having a rough day. Unless you sat on your hands, you had the fortitude to do that, or perhaps your risk manager allowed you. You had enough room to sit there and wait, and said, "Yeah, I know it's going to come back." They always say that. This time it actually did, and so you had your chance to perhaps close out for minimal pain there. We'll see if you were that savvy. And of course, that kind of wraps it up for the week. Tomorrow, just Johnson controlled, not even Johnson & Johnson, and Xerox. Like I say, the old big name, kind of not so much these days out there in Xerox land. But a crazy week from an earnings perspective. It seems like, Mark, the narrative has shifted now. Macro, at least, behind us for the time being. China, not so big of a deal right now. The Greek thing seems to be in the resolution phase, so it seems to put that behind us. It seems the focus is now definitely domestic, definitely on more of the micro single name type events, and that's what's carrying us going forward. Is that what you're keeping an eye on for the rest of the week into the weekend?
As I said, top of the show, earnings has been kind of pushing things around. If you look at the VIX and VIX futures, one thing we didn't talk about is they started trading VIX weekly futures today. Ah,
yes, another VIX is such a crazy week, you can't fit it all in.
Yeah, and a little moderate success. So it traded more than any other future except for VIX itself. But I think, last I checked, less than 1,000 contracts traded. But I was made a comment. You can tell I'm hanging around big blonde hair too much. I made the comment that the VIX kind of feels like the Nordstrom anniversary sale. We can where I can buy fall volatility at summer pricing, because I saw that October was trading into the 12% in the S&P 500, which is relatively inexpensive, especially given that a lot of the risk that we're seeing is being pushed into September. A lot of traders are looking at September and think there is some sort of risk there. So I think this sell-off is going to be short-lived, and the fact that earnings in big companies have been this bad and we've recovered, we've managed to basically stay above 2,100 is pretty impressive. So, I think we're going to get a nice little gasp higher, but then things may fall out.
You've definitely been spending too much time in ladies' retail and ladies' fashion, because your analogies are starting to shift from 80s TV shows to to weird seasonal fashion
the Nordstrom anniversary
that have three quarters of our audience are not going to get. A small percentage, perhaps. Oh, yes, I agree with him on that Nordstrom rack analogy, but the rest, no. But good stuff nonetheless. A crazy week. Certainly, those of all of you out there, recent weeks, until, of course, the last couple of weeks, have been lamenting nothing to trade, nothing to going on. Well, here we go. We have some stuff actually to watch, some things actually popping off. So from an options perspective, you certainly should have your hands full in terms of at least attractive names to trade. So that's always a good thing for a show like this, because it gives us stuff to talk about, gives you guys stuff to trade, which we like. And that's going to do it for the Around the Block segment. We'll see how these names all open tomorrow after this earnings palooza day, see how much of these moves they keep. If it's like some of the other names we've seen last week, they're going to keep a lot of it, and in which case that's going to be interesting going forward. Speaking of interesting going forward, Mr. Sebastian, what do you guys have cooking over there in the land of the pit that will interest our listening audience?
You know, we just finished up our calendar course on Saturday, and not a lot of exciting things. I'm doing a multi-speaker event with Andrew Keene that I've on Saturday that I've tweeted out a couple times. So catch me at there, and then read our blog, optionpit.com/blog.
Surf on over there, optionpit.com/blog to learn more. Sign up for some of their events and all that good stuff that they do over there. And on behalf of the Greasy Meatball and indeed Uncle Mike, who couldn't be here today, and myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. Keep them coming. And we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.